Okay, so here we go, some more bookkeeping, and the next stage is we're going to look at some transactions which I've got written down here. I'm going to develop the transactions. I'm going to show you how to reference the accounts to each other, and this is really about getting used to the way the transactions work and manipulating assets, liabilities, expenses and income, and in particular then developing something called a trial balance. Now, a trial balance will be at the end of the bookkeeping exercise. We're going to list all of our debit balances and all of the credit balances, and hopefully the total of the debits will equal the total of the credits, because all debits should equal all credits. Alright, so let's start then. First transaction I've decided on is we're going to start the business with £1,200 business bank account. So as we know, bank is an asset. Assets are debits, £1,200. The other account involved is capital, which I'll abbreviate. It's transaction 1. So on the capital account, which we know to be a liability, I'm going to therefore credit £1,200. Capital, liability, liabilities are credits. It's in the bank account and it's transaction number 1. So these, this way of writing the transaction enables you to see a debit and reference the credit, or see the credit and reference the debit. Okay, transaction 2, we're going to make purchases using the bank for £120. So we look at purchases. We know purchases to be an expense. An expense or expenses are debits, so £120 on the debit side, and we're using the bank, so bank is the other side of the transaction. It's transaction number 2. Now, when I'm numbering these transactions, you can see those numbers as dates. Sometimes dates are used. I'm just numbering because it just lends itself to a nice sequential approach, but you can see them as dates. So we've made this purchase using the bank account. So £120 is credited to bank, because bank is an asset. We're reducing the asset, hence it must be on the credit side. Purchases, which I'll abbreviate, and it's transaction number 2. Okay, so we're up and running. Transaction 2 dealt with. Transaction 3, this time we're going to make purchases on credit for £325. So purchase on credit won't involve using the bank account. We'll be using payables. Remember, payables are liabilities, amounts we owe our suppliers because we've had the supply but not yet made the payment. So £325 purchases. So we make the 325 debit to purchases, because purchases are an expense. It's going to payables, which I'll abbreviate. It's transaction number 3. And on payables, £325, liability therefore credit. It's from purchases, abbreviated, and it's transaction number 3. Good, transaction done. Transaction number 4, this time we're going to make sales for £432. Now, sales is an income account. Income recorded as credit. So we look for the sales account. There it is. £432 income credit. Transaction number 4, and it's going into the bank. Bank is an asset. We've got more asset by 4, 3, 2. Transaction 4 from sales. There we go. Transaction 4 complete. Transaction 5. There are only 11 of these transactions. So transaction 5, make sales on credit £560. So sales on credit won't involve the bank, will involve receivables. Receivables are assets. They describe amounts that we are owed from a credit sale. So we're going to credit sales £560 to record the income. All right, so it's quite important to get used to the idea we record the income even before we've had the cash. We've got a contract, and it's reasonable to record the income. So we record the income, £560, it's receivables, and it's transaction number 5. Receivables are an asset. £560 debit then, and sales and transaction number 5. Transaction number 5 done. Transaction number 6, we're going to pay a credit supplier £150. So if we pay a credit supplier £150, we're going to reduce the asset of bank, hence a credit on bank, and we're going to reduce the liability of payables. So we're going to debit payables. So 150 leaves the bank to payables. It's transaction number 6. So 150 on payables, 150, transaction 6 from the bank. So we've reduced our liability. Payables is a liability, reduction of a liability is a debit entry. So you can see what's happening there. Transaction 7, receive £400 from a credit customer. So if we receive £400 from a credit customer, we've got a positive asset into the bank, £400 from receivables. It's transaction number 7. So we increase the asset of bank. We're going to reduce the asset of receivables. So we look at receivables, and we're going to reduce the asset of receivables by £400, went into the bank, and it's transaction number 7. Transaction number 8, we're going to buy a car using the bank for £80. So reduce asset of bank, hence it must be a credit, in favour of car, transaction 8, and car is an asset, £80, so bank transaction, and it's transaction number 8, so the 8s match up. Car bought. Next thing, pay rent, £25, we're going to pay the rent for 25 quid. Rent is an expense, expenses are debits, £25, rent, using the bank, transaction number 9, reduction of bank, £25 in favour of rent, transaction number 9, pass it through. Transaction 10, owner takes out £90. We call this drawings. Now drawings are a slight oddment in that they're not expenses or assets for that matter. Drawings are regarded as a reduction of capital. When the owner puts money into the business, that's capital. When the owner takes money out of the business, that's a reduction of capital, which we call drawings. So whereas capital is a credit entry, drawings are a debit entry. So we'll debit drawings £90. It's a bank amount, it's transaction 10. So it's coming out of the bank, 90, in favour of drawings, transaction 10. And then finally, there's a loan taken out for £100. So the business has taken a loan out for £100. So £100 lands in our business bank account, and there's a liability to repay the loan of £100. So £100 into the bank by way of loan, transaction 11. So we look for the loan account, £100 liability, liability is a credit, it's in the bank, and it's transaction number 11. Okay, that's a quick whip through the actual transactions. The next step is to find the balances on each account. In other words, is there more on the debit side or the credit side of each account? Now, some accounts it's fairly obvious. So if we look at the capital account or the loan account, you can see clearly they have credit balances. There's more on the credit side than the debit side. But some accounts are not so obvious. If we look at the bank account, not immediately obvious. If we look at it a bit more closely, we can see there's more on the debit side than the credit side. Question is how much more? Once we know how much more, we can find the balance on the account. So I'm going to do a little sum. I'm going to add up the debit side. That's 1632, 2032, 2132. So 2132. 2132 more on the debit, on the debit side. Question is how much more? So I need to find out the amounts on the credit side, deduct them from that figure, and that will give me the balance, which I'm just going to slip into that space. So let's see how much it is. 270, 350, 375, 465. Just going to put that there for a minute just to do a sum. 465, so that's 2132, 1732, 1667. 1667 is called balance carried down. Get rid of that a minute. And 1667 is called balance brought down. So there is 1667 more on the debit side than the credit side of the bank account. The 2132 has no significance other than to say both sides now are the same. And that just gives a little bit of mathematical accuracy to our closing balance. 1667 is the figure because there is more on the debit side than the credit side by 1667. So that 1667 I'm going to use as the balance on the bank account. So that sits there, bank account balance taken. Capital account is 1200, on the credit side 1200. Loan 100. In we go. Payables. The payables balance we can see here is 325 less 150, that's 225, 175. So 175 is balance carried down at the end of the period. Balance brought down is 175. Both sides of the account now add up to 325. So 175 is the payables balance. 175. Next one is receivables. The receivables account here, we could do the same thing. Balance carried down is 560 less 400, which is 160. Balance brought down 160. That's the asset balance. Both sides now come to 560. 160 balance on receivables. There we go. Give that a tick. Next account I'm looking for is the sales account. Save myself a bit of time here. We can clearly see there's a credit amount there of 992. 992 on sales. Put that in there. Purchases has a debit amount of 445. 445 on purchases. Rent has a debit of 25. Quite clearly. Car has a debit of 80. And drawings have a debit of 90. Okay, so proof is in the pudding, as they say. If my bookkeeping has been done correctly, then the debit column and the credit column totals should be the same. So let's just see if they are. So 1475, 2375, 2467, 2467 on that side. 1667, 171827, 2272, 2297, 2377, 2467, 2467. Okay, so that was a quick bookkeeping exercise to show the manipulation of debits and credits through T accounts, showing how the entries are connected. The debits and credits are connected, so we can see the other account in any transaction, which is very useful if an error is made. And then how to balance off the accounts, how to find balances on the accounts to create a trial balance by way of a double check to make sure no errors have been made. Doesn't reveal all potential errors, but quite a few of them. We then total up the debits and the credits. If both sides come to the same figure, then hopefully we're on the right track.